Before every budget, we ask veteran global investors their view of India's prospects as an investment destination and what they want from Indian policymakers or even from the budget. Joining me today on What the World Wants from India is Russell Napier, veteran economist and macro strategist, formerly with the CLSA but now better known as the co-founder of the market intelligence research site, ERIC, and author of the macro report, Solid Ground. Russell Napier, thank you very much indeed for joining us in what are very important moments or periods when Indian policy is analysed. Now, before I come to the Indian policy, Mr. Napier, you were the first to forecast that the world will head into an era of inflation. But now that many of the global central banks, important central banks, have hiked rates, would you say the near-term fear is recession rather than inflation?
Well, you can have recession and inflation.
Yes.
It would likely be lower inflation, but it would still be inflation. So clearly there is a risk of inflation. The question for investors is how negative would a recession be for stock markets? Okay. Stock markets have fallen a long way ahead of this recession. They always fall ahead of a recession, but not usually by this magnitude. So really the key question we're asking is just how bad a recession will be. And we have a little template of 2020 when we had a really in terms of its short-term duration, short but huge magnitude recession, and had very limited impact on the equity market. So what we're talking about is a new form of recession, or really an old form of recession. And that is one today where there's lots of government support, huge amounts of fiscal support, huge amount of subsidies on energy, now massive interference in residential property markets, huge interference in banking by governments. I think the net situation with that is that we don't get a recession which is particularly bad for corporate earnings, and certainly not one that threatens insolvency, as the last three recessions seem to have done, or at least the market thought they had done. So I don't fear the recession as much as other people. It will bring down inflation. It will bring down short-term interest rates. The impact on corporate earnings, I think, will be more muted, certainly than the last three. And therefore, it's not going to be particularly bad for the equity market. However, it does raise serious long-term structural issues about the relationship between government and markets. And I think that's more of a bigger long-term issue and ultimately more important than the magnitude and duration of this recession.
Can you develop that point further? How do you expect this relationship to evolve? Do you think we hit back to inflation? Do you think the governments all over the world will continue to pursue negative real rates, which is what you had forecast?
Yes, absolutely. The call in 2020 was for higher inflation, but it was part of a financial repression. Yes. And the crucial part of a financial repression is that rates cannot reflect inflation expectations. And I mean right across the yield curve. Now, we have a very, very dangerous situation building up in Japan at the minute. And this may be when the penny finally drops for investors, that we realize that governments and central bankers are simply not prepared to live with higher rates. That's not their vocabulary, that's not their language, that's not their statements, but it will prove to be the reality. So the great shock, I think, that could come out of Japan is if the Japanese authorities, and this would be the Ministry of Finance rather than the Bank of Japan, force Japanese investors to buy government bonds, compel them to buy them at a yield that today may be slightly higher than today. And then we would realize that the world has changed, that the so-called risk-free rate is an entirely artificial rate, not determined by central bankers, but determined by the government. So that's the second part of financial repression. It's yet to come to pass, but Japan may bring us to that quite quickly.
Okay. Well, in that case, if the central banks and governments more particularly are going to follow a lose money policy, a negative real rates, then we should have inflation back before long, right?
Well, inflation is coming down and it will come down further. But if the government mitigates in any way the impact of the recession, then that mitigates against crushing inflation. I also believe that this is part of a larger policy that the government wants inflation. Now, it doesn't want it at the current level. We're talking developed world here. But it's very happy to see it between 4 and 6, because alleviating these crushing debt burdens is going to need inflation roughly around those levels. And for your viewers who saw the data out from the United Kingdom yesterday on the scale of the government budget deficit and just how much of that deficit is now composed of interest expense and inflation compensation on index-linked gilts, I think we're beginning to realize that the world simply can't live with higher rates. So inflation mitigates, but doesn't come back to two, doesn't come down to two. The governments want it to stay higher. And I think that's the new normal that we have to get used to.
In that case, what are you advising investors to do with their money? Do they invest in developed markets at all? Would you prefer emerging markets, at least because they follow more orthodox policies?
Yeah, so yes would be the simple answer to that. Emerging markets find themselves in a very different position because post-Asian financial crisis, they haven't racked up huge amounts of debt relative to GDP or huge amounts of interest expense relative to personal consumption expenditure. China is the exception to that. India is quite clearly an undergeared country. It's one of the great achievements of India over the last 15 years that it has grown without a dramatic rise in debt. Now, a rise in debt for sure, absolutely, but nothing compared to the way China has only been able to grow by adding lots of debt. So absolutely looking more at emerging markets, but buying cheap equities. I mean, it is said that the lesson from the 1970s is that equities cannot defend you from inflation. I think we all know how badly they did during the 1970s.
Yeah.
But actually, the real lesson from the 1970s is that highly valued equities cannot defend you from inflation. Now, when you look beyond the US, beyond the S&P and beyond the NASDAQ, you do find cheap equities everywhere. This is India's problem. India's problem is not a macro problem. India's problem is a valuation problem. It's on about 3.6 times book value. If we look at the average for the emerging markets, you're looking at about 1.5. So there is a rather big gap in valuations here. So the macro situation may be set fair for India. But if the answer is buy cheap equities to defend yourself from inflation, India doesn't feature so heavily on the radar screen as the Indonesias, Malaysias, and Thailands of this world in terms of the emerging market universe.
Okay. So you would wait for better valuations to buy India?
Yes, I say that, and I've been waiting for a very, very long time. This is the problem, isn't it? For all of us who are interested in value, we wait for such a long time.
Yeah.
I've missed some of the India boat, but at this valuation, it seems too expensive for me, even given the incredibly optimistic macro outlook I think that India genuinely sees before it.
Well, a union budget is upon us, and there is a call from economists in India that the fiscal deficit should be brought down from the 6.4% this year to at least 5.8% next year. Basically, India spends about 20% of its expenditure budget, only in interest payments. So would that be your call as well, that deficit should be brought down?
Well, there are other things you could do. That's not a major change. That's a tweak, I think, rather than a major change. The question for India is, can it sell its government bonds? In a world where I think governments will genuinely be struggling to sell their government bonds. And of course, the focus would be on the highly indebted governments of the world, which isn't India. So you have to make that bond market as attractive as possible to locals, but also to foreigners. So in terms of locals, I think the Reserve Bank of India has followed a very good policy on money supply growth, bank credit growth, and inflation. But so what's the problem now? The problem is the inflation generated by the rest of the world, and India is obviously an importer of that inflation.
Yes.
So I would focus on getting in more capital. I mean, there is a wealth of capital now, likely looking for a home. We call it friendshoring in one form, which is foreign direct investment. I'd argue that portfolio investment is another huge potential flow into India. I think the equities may be overvalued, but actually the bonds could be quite attractive to many foreign investors. So my argument would be not to focus so much on bringing down the fiscal deficit, but to make that bond market even more attractive to foreign investors. It has its long-term issues if you let foreign investors own too much of your bond market, but I think India could find a good financing for that, given its debt to GDP ratio, and what I think is a sound policy by the RBI. So I think funding it won't be too difficult. If funding it becomes a difficulty because the rest of the world is in such a mess that India can't attract capital flows, then that's very different. So we have to work at the minute that capital can be attracted. It can be attracted to the bond market, and that should be a focus. If things get really bad, I mean, capital controls in the developed world, then everybody's going to have to adjust a dramatically new policy to cope with that sort of world.
So trying to get into the global bond indexes should be something India should work for.
Absolutely. I mean, why not? I mean, India's going to be one of the biggest economies in the world, already is one of the biggest economies in the world. There is capital out there. India needs capital. Why shouldn't it be pursuing some of that capital? So I don't think that the only downsides, obviously, in the long run, are that capital can be quite flighty and it can disappear again and that can spike your rates. And That's been a long history of emerging markets. I suspect it's why some policymakers are fairly wary of allowing it to happen. But I would still be in favor of allowing that to happen and to benefit for India to benefit from all the forms of capital that I think are increasingly available if we don't move to a period of capital controls in the developed world.
Fair enough. Yes, that can't be ruled out. But Mr. Napier, I don't know how closely you look at India, bottom up. Clearly, you have a great macro view. But bottom up, are there any specific sectors that attract you?
No, I mean I can't pick sectors out. What I can say is that companies, whether they're Indian, American, Mexican, or British, that have suffered under the yoke of Chinese competition, are places really, really worth looking at. These companies, I think we're going to be doing less business with China. May get to a fairly extreme form of less business with China. And to the extent that there are smaller companies in India which have not been part of the kind of long-term rise in valuations because they've had to compete with China.
Yeah.
That is where I would be looking. So none of the, I don't know enough about India to pick any of the big names that are in the index, but I suspect beyond the index there are companies, and those companies should now be able to expand as well. So you would have better margins and expanding capacity, but I'd be surprised if they were large stocks in the index, because I'm not sure that manufacturing or that type of thing that it's been competing with China has really composed a large part of the index. So I think there will be, as there are, in all the markets, somewhere languishing outside the index, are quite a lot of the winners of the world prior to the emergence of China. And we should see a renaissance for them. So I suspect there'll be small companies, relatively liquid companies. They may not have had any visitors from fund managers for a long time, but they could be incredibly good long-term investments.
Okay, we'll do our research on that within CNBC-TV18 itself. But just the last word on the budget itself. You did speak about attracting bond investors. India has gone out of its way with its production-linked incentives to attract the China Plus One investors. Is that a path India should pursue, the policymakers?
Yeah, absolutely. As I said, there's a lot of capital. China took a huge share of global capital flow for really 25 years. That is up for grabs. If India doesn't get it, somebody else will get it. Mexico looks attractive. I think Indonesia looks attractive. Obviously, some of the other countries have got smaller labor and workforces, but this is India's opportunity. This growing Cold War creates lots of opportunities. And I think people of India can see that in terms of how the Prime Minister is positioning to be in some way non-aligned, but slightly aligned. The ultimate where the rubber hits the ground in India benefiting from all of this is getting this capital and a share of this capital, which is now up for grabs. So that should be the focus. And it's a great focus because it's not necessarily, this is not a government-driven investment policy. It's not a government industrial policy. There is private sector capital ready and willing to come, and it will find its own ways and based on profit. So this is I was going to say a once-in-a-lifetime opportunity, but it may even be longer than that before another job opportunity like this arrives. Just
one quick last one, if I may. Is it good to go with gold since you do see inflation persisting?
Yes, in several ways. First of all, yes, because it comes down but persists. Secondly, because US interest rates come down. But the most important is what's happening in Japan. And it may be where the gold price has started to perk up a little bit. There are only extreme answers to the problem of Japan. I have my extreme forecast, and that is that the government forces savings institutions to buy government bonds. But the bottom line of a financial repression is the government gets more involved in telling you where to put your money. Now, that's because your money is probably in a regulated financial institution. Gold is one of the few assets which operates outside that system. And therefore, I think gold is the go-to asset in a financial repression. In extreme circumstances, it can be confiscated. We all know that President Roosevelt did that. But it's such a small proportion of global wealth that seems unlikely. And then we have central bankers who are perhaps concerned that America, France, Germany, the United Kingdom, Switzerland, Singapore might seize their wealth the way they seized the wealth of Russia. Well, one of the very few assets that you can own and actually hold domestically would be gold. So there are many, many, many things lining up to be very optimistic for the gold price. Okay, the Indian housewife was right after all. Thank you very much, Mr. Russell Napier, for joining us. Everything you say, always worth their weight in gold. We have to take a quick break, and thereafter we'll be joined by Brian Jacobsen, the Senior Investment Strategist of Allspring Global Investments. Well,
Welcome back to our pre-budget special, What the World Wants from India. Joining me now is Brian Jacobsen, Senior Investment Strategist with Allspring Global Investment. Now, Allspring has an emerging market equity fund which has 12% of its funds in India, with Reliance Industries and HDFC Bank ranking in their top 10 holdings. Brian himself heads the multi-asset team at Allspring. So, Brian, thank you for joining. And before I come to India and to the upcoming budget, what's your global pecking order in terms of asset classes, and what's the pecking order between developed markets and emerging markets?
So here at Allspring on my multi-asset team, we actually are coming into 2023 with a fairly balanced mix between equities and bonds. So if you think about 2022, everything seemed to sell off together. Balanced portfolios did not do very well. We think balanced portfolios can stage a comeback in 2023. But when we're thinking about within the equity portion of the portfolio, we're actually very bullish on emerging markets relative to, say, US markets. We think there are opportunities in the United States, mostly in the small cap value and large cap growth areas. But we're a little bit more excited about the valuation opportunities and the improving fundamentals in emerging markets.
Oh, that's good to hear. So now where is India in the pecking order in emerging markets?
Yeah, and so when we look at the broad spectrum of emerging markets, right, you have to look at it country by country. And India did very well over the last few months and even over the last year, especially compared to an area like, say, China. Now, looking forward, we do think that there is some good momentum in India. There's a lot of concern that, say, valuations are elevated in India relative to other areas like China. However, we think those valuations can be justified on the basis of the strong economic momentum that we see in India. And we're just hopeful that that momentum can continue to carry forward.
Okay, now let me come to the budget. How crucial is the budget for the Indian economy? What will you look for in the budget?
Yes, so I always love looking at the budget because it really sets the policy priorities for the government for not just the next year, but even the longer term policies. Going into the budget, there is a lot of expectation that we're going to see some structural reforms, some improvement as far as investment in, say, clean energy, manufacturing, improving labor market conditions, infrastructure investment in general. And so there's already a lot of expectation that we're going to see this type of investment in what will hopefully benefit India over the long term with growth. And that could then confirm the idea that India will continue to be one of the top growers in the emerging markets, not only for the next year, but even over the next multiple years.
Okay, got that. But how important is the fiscal deficit number itself? Will a high number scare investors like you?
When we're thinking about this as far as the fiscal deficit, as long as the deficit is for good reason, if you think about the government spending, if it's an actual investment in the future, that's not all that bad. So the deficit on its own doesn't matter as much as the quality of the spending that the deficit is helping to fund. So we're looking at probably around 6.4% as far as a percent of GDP in the fiscal deficit. And that seems to be about the consensus on Wall Street.
Yeah, I agree. 6.4 is for FY23, the current year, of course. But, some in India fear that this could be a typical pre-election budget. After all, the government goes into elections next year. So would that be the big scare, any budget giveaways?
The way we look at it is, yeah, we always have to be aware of when the elections are. And if it is a giveaway budget, and not just for India, but this applies to other countries as well. I would point to, say, like Brazil as being another example, is a big budget. If they do, say, disappoint where it's too high of a deficit, is it because it's a bunch of giveaways? that is typically viewed as being negative. Now, when we talk to the different credit rating agencies and different analysts as far as the expectations of the budget, right, it's a stable outlook. It's not viewed as being a giveaway budget, but if it does become one, we would view that as being a negative, and we would expect to see probably the currency go down in value relative to the US dollar, and probably also yields and interest rates move higher relative to developed market bonds.
Okay, now let me come to other issues. What are your thoughts on the Indian rupee? Are there any worries that it may depreciate a lot this year as well?
Yeah, so whenever we invest in a foreign company, you're also investing in their currency. So we always have to be aware of that currency translation. The weaker currency should have been beneficial to the export picture. Now, India as a whole still has a trade deficit. Maybe a lot of that can be explained by the high natural resource prices as far as imports of oil and the such. But from the company by company perspective, that weaker currency was hopefully a tailwind to their foreign earnings. Now, going forward, we actually do believe here at Allspring on my multi-asset team that the currency is likely to continue to appreciate or go up in value. So we view that as being beneficial as a US-based investor, looking at if it goes up, if that company's stock goes up in rupee terms, and we can also get a gain on the rupee, we view that as a double benefit. That's our expectation. A lot of that does depend on the budget. Is it too big, which could then push the currency lower, and also monetary policy. Monetary policy to us looks like it's been very prudent, that they're getting close to the end of needing to hike rates because inflation has come down. So we actually have a positive outlook on the rupee for 2023.
Okay, well, actually, that is the consensus of the street. The rupee actually has appreciated even over the last couple of weeks, and people see it going even towards 80 or 79 by the end of the year. Okay, now your favorite sectors in India, Brian.
Yeah, so when we look at from a sector perspective, we work with some really talented portfolio managers. Allison Shimada is one of ours that they really focus on doing the individual stock selection and sector selection. So kind of from that very high level view that my team operates on, which is more the asset allocation as far as country allocation, we're positive on India. We're broadly speaking positive on financials as we go into 2023.
On that optimistic note, Brian Jacobsen, thank you very much for joining us. With this, we wrap up our pre-budget special, What the World Wants from India. We'll be back with more news and updates in just a bit.